Hey traders, welcome to this video. Will Sebastian here from the Trading Mentor. Of course, as always, if you want to get our free training, go underneath this video. We also teach live on Zoom every single day as we are real traders. We trade for income ourselves and we teach a large academy. So let's go ahead then. Japanese index, the JPN225, the Nikkei 225 index. I've got it on the 1 weekly chart on Pepperstone. You're currently sitting at 40,664 points, just changed down below 660. So this is something loads of traders are looking at. Sometimes people ask me about it as well. I've done a few posts on it in the past. What I do like about it is what you had sort of yesterday, okay, or closing into the early hours of this morning. There's a nice push up to these re-highs. Now, at the moment, you've got a changing in stance of the Bank of Japan. They're putting rates up, albeit very slightly. You got to 0 from 0.1. So there was an accommodative stance, and now it's slowly coming out of that. So as rates get higher, of course, that doesn't really accommodate business, because if rates are higher, people pay more interest. So when they're paying off loans, things like that, they're getting squeezed, and therefore they won't be buying as much from businesses, and therefore businesses don't make as much money. Now, the reason why the latest change hasn't really done an awful lot, I mean, initially you have pulled down, okay, that's a positive sign, 41k to 40, so not an awful way, okay, 1,000 points or so. Because the change is not massive and the risk on environment persists across other indexes, you didn't see a massive fall, and more or less the rebound sort of came around your 40 MA. So withstanding the long-term uptrend on the 4 hour, your stock oscillator comes back to the overbought zone still, okay, and then you've got this big rejection here. So price clearly from the perspective of long-term investors isn't preferred there, and it's not preferred there. And you're starting to see a little bit of a sell bias creep into the market. If you go onto your daily, the picture looks a bit better actually as well, because that push straight back up, which could be the new forming downtrend, brings you straight to your former all-time high, and a big candle wick is printed. Now, the reason why also you bounced at this point, and the reason why you wouldn't expect price to fall through straight away, comes for a few reasons, really. Number one is the support, which you can see here. So that was an ideal exit zone, because this support is so early on in the fall at this point that you've rebounded straight away. Okay, and it also comes about as there's still a risk on market. Like I said, investors are still happy to take risks. So, traders will buy at these points rather than get short. So it's going to be the case really with this particular index that once you get that catalyst, you'll probably blow through that former level, because that former level won't be strong enough to hold, especially given you've risen from there and come straight back. Okay, so clearly there's not a massive long side bias is what I'm saying. I think ultimately, therefore, depending on that harsh or perhaps risk-off environment at the time, you'll come nearer your 20 MA on your daily, and you'll probably hit onto early support there, and then slowly break through the market as time goes on, and as you break more and more levels of support on the way down. Again, that would require a persistent risk-off, lessening in the long side bias. And ultimately, in more extreme cases, or perhaps in relatively normal cases, I mean, it's not actually that far down, you may see a pushback. I think ultimately you will get down here at some point, because you're just so far off these key moving averages. You draw your eclipse like that, you're miles, absolutely miles off it. Okay, and I think if you do fall, you'll slowly see your average creep up, and it will take you around that 37k area. Now, as a fib level and as an overall retracement, that level sits about 38.2%. So you can see it's not an awfully long way down anyway. So you would need to see something in the market in either Japan or on the global stage that gave you that idea. I mean, if you suddenly get something out from the Bank of Japan where they really want to put rates higher, Obviously, that's going to affect business, like I said, because businesses, their customers, they're not going to have as much money because their money is going to the bank. And the interest or loan companies or whatever it may be, wherever they're getting their credit. So it will be also, wise to decide, should I long at this point? Well, that would probably come in line with how harsh the sentiment is. If that sentiment is really harsh and it's risk off, okay, then you might want to lessen your size, because if you end up getting down here, which again is probably a really solid investor long zone for me, somewhere I would really like to get long, then you may end up down here. And in more extreme cases, down here. And you can see, actually, this is a really interesting long side level, because this price point here is, it dipped back and hit straight onto this key support and rebounded immediately. So this is another example at this point over here of how a market, when it falls and comes straight to early support, you will find that unless that sentiment is really strong to the downside, you will simply just rebound back to the upside like this. And that's exactly what happened, and has brought you where you are now. So in short, I like it short. If you're going to sell it, don't go crazy. Trade it really light, space your entries out, and I would stage your exits. The longer the target, okay, the further down the target, the longer you're probably going to have to wait. And it may take a bit of time. So just bear that in mind. But thanks for watching, guys. Don't forget, we're real traders on charts every day. You can join us underneath. And of course, subscribe, like, comment. I will see you in the next video. See you then.